Thank you, Rebecca, Meltem, and Colleen for joining me today. I got a lot of really interesting ground to cover, but first, just a couple of quick housekeeping things. First of all, a big thank you to Aave. So thanks, Rebecca and team, for making this possible. A couple of quick words about Aave. I'm sure most of you who are listening are probably familiar, but Aave is an open source and non-custodial liquidity protocol for earning interest on deposits and borrowing assets. There are a couple companies in crypto that are defined by their ability to execute. I would put Aave right at the tippy top of that list. So a big well done to that team, just in a very short time accomplishing so much. They're also, I think we'll probably touch a little bit today on what they're doing on the institutional side of things with Aave Pro, which is very, very cool to watch how quickly they've grown and how much of an impact they've had in a relatively short amount of time. With that, I want to just dive in here and just do a quick round of intros before we get started. Rebecca, since I teed you up there, you want to take the lead?
Sure. Hi, I'm Rebecca Rettig. I'm general counsel of the Aave companies, which is the group of software development companies that built the Aave protocol. We're an open source blockchain-based software development company. We are continuing to innovate and build lots of different protocols that hopefully you'll learn about soon, but we also build Aave.
Awesome, thanks. I'm just going to go in the order I see on my screen here. Colleen, you want to go next?
Sure, thanks so much for having me. I'm Colleen Sullivan, co-founder and CEO of CMT Digital. We trade and invest in the crypto space. CMT Digital is a subsidiary of the CMT Group, which was founded about 24 years ago. Proprietary trading firm at core, traded all around the world in the traditional equities and commodities markets.
Awesome. And last but certainly not least, Meltem.
Hi, thanks for having me, Michael. Meltem Demirors, Chief Strategy Officer of CoinShares. CoinShares is a publicly listed digital asset investment firm. We have a number of different business lines, including our exchange traded products. We have 3 different ETP platforms that we directly manage with 5 billion in assets under management. And then we've also invested in a number of asset management platforms around the world. We have a trading capital markets business where we engage in non-directional trading, liquidity provisioning, and other electronic market making activities. And then I spend a lot of time on our investment portfolio where we deploy capital out of a venture fund and from our balance sheet. So that is CoinShares.
Awesome. Thanks so much, everyone. Yeah, really excited to dig into this topic. Meltem, I know market structure is near and dear to your heart as well. So if you'll allow me to set the scene here, just talk a little bit about the evolution of market structure in crypto. At the beginning, there was nothing, right? Basically, the only way to interact with crypto is to do peer-to-peer sort of transactions. Then you had kind of the very early iterations of exchanges, sort of the Coinbases and the Bitstamps of the world. Then you had kind of supporting infrastructure like Genesis sort of come into play, a developing OTC market. Now, fast forward to where we are today, there's a really interesting new development in market structure, which is the rise of protocols like Aave, borrow and lend protocols, trading protocols like Uniswap. These are totally emergent new phenomenon. So I'd love to hear from you all. How is this huge change in market structure kind of impacting you as market participants? Like, what are some of the biggest trends that you're seeing?
I can kick it off if you like, Michael. So the way we think about it as a firm who started everyone at our firm has a commodities background and a traditional markets background. And if you think about how traditional market venues are structured, there's sort of 5 steps in the process. There's price discovery, trade execution, clearing and margining, settlement, and then post-trade reconciliation. And today, for a lot of people who trade on various brokerage platforms or institutional trading platforms, whether they're retail or professional traders or investors, typically all of that is aggregated into one vertically integrated platform where all of that is happening within one institution. And those various layers are then organized in a sort of hub and spoke model. So for example, the CME only really has a couple of thousand clients, and of those, a small percentage comprise the majority of their volume. And the securities and assets that people are trading in many instances are held in street name. And with DeFi and with crypto more broadly, what's been happening, which is really cool and just like so fun if you're a market microstructure person, is all of those layers of the stack are getting smushed and disaggregated into layers of open software. And so what's really cool is instead of facing off against an intermediate intermediary or an exchange, I can now face off against the market of millions of users and millions of individual wallet owners, and I don't have to know who they are. There are a lot of different evolutions of this model, obviously, and permission sort of networks where you have only institutions or whitelisted participants. But the general concept of abstracting these institutions and their sort of walled gardens into these layers of open software is what has really allowed for DeFi to happen. I mean, the novel innovation of Bitcoin is for the first time I could trade without an intermediary and settle peer-to-peer, clear how I want, margin how I want. And there is really not a whole lot of post-trade reconciliation because the public ledger, right, the Bitcoin blockchain is my reconciliation layer. I see all of the activity there. And so it really started with the Bitcoin OTC market. We've been investing in market technology platforms that are bringing the innovation of blockchain technology to the broader sort of capital market space. But I think, again, with DeFi, what's so cool is we've made all of this into these layers of open source software. And like Rebecca and Aave, here's a $25 billion protocol. They're not an institution, right? It's a piece of software that's maintained by a group of devs, but really the rules and the conditions are all part of this software layer. And so for us, what starts to become really interesting is now for the first time, you can codify different types of investment contracts, investment structures, investment vehicles into software, and anyone with a wallet on these networks can participate. And so what it allows for is all sorts of different structures in terms of how you build and develop markets, how you curate and provision liquidity. And really the vision we have at CoinShares is markets should be global in nature. They should be open and driven by permissionless open source peer-to-peer software. And we should be able to trade 24/7, 365, not just in traditional assets, but across the many different metaverses that will exist, and all sorts of different assets and things of value that people may want to utilize as collateral to trade with, and in other sorts of financial use cases. So we're really excited about this. And obviously we've seen tremendous growth across all fronts on the DeFi side, the institutional crypto side, the OTC side, and everything in between. So it's truly so exciting.
And just to build on two things that Meltem said, one, I think when she's talking about you don't have to know who your counterparty is anymore. I think from a legal and compliance perspective, and that's probably what I'll be bringing to everybody today. So apologies for being the lawyer in the room, but I actually think that's a really good thing, right? Because frequently as a financial institution, as a trader, whatever, you want to know what your counterparty risk is. And now you're literally just interacting with software. And so that should, I mean, and Meltem and Colleen can probably speak to this a bit better, but just from a like everyday compliance perspective and efficiency of working in the system, it should really eliminate a lot of the stagnancy that happens, right? Because you just don't have the same counterparty risk. And I talk a lot about how the technology also eliminates the counterparty risk when you have the automaticity of transactions occurring. So you don't have to go through a third party. You don't have to do all the other checks. Like, you know, your transaction is going to occur as you intended to because the software is programmed to do that. And you can see exactly what's supposed to happen because the software is all open source. The other thing that I think is really interesting though, and this sort of just is a twist on what Meltem said, is, you know, we built the protocol, but we don't maintain it anymore, right? Like, you have a community, whether it be CoinShares or CMT or whoever happens to be interacting with the protocol, to have a huge stake in watching the protocol grow and can participate with proposals and governance and can move things forward. And I'm sure there will be a time to talk about it. But even seeing the, you know, desire from the community to have an institutional grade protocol, something like Aave Arc, which was formerly Aave Pro, I think is one of the really exciting parts of DeFi, and watching the entire market grow in this sort of crypto native way, I think is really exciting as well.
Yeah, and I'll pick up on a couple of things that Meltem and Rebecca said. You know, Meltem was talking about how we're kind of just at the early stages and we're going to see additional things being sort of built on top of DeFi. So, you know, I think a lot about scalability, and in order to introduce the next 100 million users into DeFi, what is it going to take? And that concept, plus where Meltem was going, I think we're seeing play out real time with Axie Infinity. Like, what happens when you introduce scalability and you bring gas fees down so retail people can really get in the ecosystem and participate? So 1 year ago, August 17th, Axie's daily revenue was about $200. Yesterday, daily revenue was 11 million. We also saw daily active users go from April, they were about, I think, 34,000 to yesterday, 1.1 million daily active users, which is just incredible. And that rise in daily active users and revenue is commensurate with the introduction of Ronin, which is the Axie sidechain. They decided not to wait to implement somebody else's scaling solution. They decided to build their own. So we've seen just revenues exponentially increase. And again, back to where Meltem was going, what I think is really important here is 95% of Axie's marketplace revenues go to the gamers. The 5% fee on those transactions go to the Axie DAO treasury in addition to the breeding fees. And that DAO is going to gradually decentralize so that those revenues continue to be shared across all the users. And to Rebecca's point, those users are going to be the ones determining what happens with the game going forward. Will Sky Mavis continue to be the developer? Will they bring in other developers? So we're really entering a completely new paradigm that is not, just DEXs, and it's the interoperability and the building on top of DeFi. In many ways, I don't think we've even gotten to the good stuff yet.
Yeah. Wow, so much good information there. I'm not really even sure where to start, but basically I want to touch on something that each of you kind of just mentioned. Basically kind of this idea of transference of risk, right, from counterparty risk into smart contract management risk. And we kind of saw that play out pretty recently with that large hack that ended up getting returned that I want to talk about. Meltem, I think what you were kind of alluding to is this idea of an open financial system. Currently, we have a very closed one. We have a very limited amount of participants that can kind of interact with it. And what are the implications of opening that up? And then Colleen, I kind of want to end with what you were just saying with how do we really get full scale adoption here, and how do we onboard the next 100 million users or billion users or whatever it is. So maybe Rebecca, I'll kind of pick on what you said first there, and this idea of eliminating counterparty risk by interacting with a software. There's a great quote from, I think, Chris Cole, which is, you can't destroy risk, you can only transform it. And while you're eliminating counterparty risk, what you're actually doing is incurring a different type of risk, which is smart contract risk. Is that like a correct way to say it? I mean, how do you think about kind of balancing or like just doing risk management in this new paradigm?
I think there is, just like this is a whole new asset class and a whole new way to work through things. I do think risk mitigation or risk management also is developing in a new way. So people will say like, oh, this is an insurance mechanism, and it's not insurance. It's just a new way to think about, as you're saying, risk transference. But I think that everyone is really still innovating on that, right? So we have something called the safety module, which is really intended to help users in the event of a shortfall event. Or you have the ways that the protocols, have these fee collectors or reserves that, in the event that you need to have any risk mitigation, the users can potentially, tap into the ecosystem reserves and things like that. So I think that there is a new paradigm for risk management. As far as shifting counterparty risk into smart contract risk, I'd say yes. I don't know if I think that's the right way to say it. I think that there are a number of different types of risks in DeFi. Generally, Colleen and I sort of talk about them and how to think about them a lot, but they're so different, right? We've seen things like Oracle risk. And as you're saying, you've seen the risks with smart contracts, but I do think that for the software developers who are being incredibly responsible, you can mitigate that before the software is ever really deployed. Maybe not perfectly, right? There's no perfect system ever. The traditional financial system is certainly not perfect. I think we can agree on it, including on risk management. But we and a number of other software developers publish all of our security audits publicly. You can see them, right? Like there's just a level of transparency in this system that does not exist in other systems. And I was speaking to the CEO of a financial institution, a traditional financial institution, and explaining DeFi to him for the first time. And he said, this entire system takes our business model and turns it on its head. So he said, well, we are traditional finance is a black box, and we keep all the information and we keep all your assets. you guys don't hold any of the assets and all of the information is public. And I think that creates for a much better, more robust system. And one last point, and then I'll let everybody chime in because this is a very interesting topic. And I think Meltem and Colleen probably have really great viewpoints on it as well. But, you know, in terms of onboarding the next 100,000 users, the way the system is set up means that should happen much more quickly than in the traditional financial system, because there are known roadblocks that have been in the traditional financial system for years and years and years, that the next 100,000 users who have historically been disenfranchised or just not able to get bank accounts and things like that can do in DeFi by picking up their phone, you know, and fine, they may not have a phone today, they may not have access to the internet today, but the ability to get those things is a much smaller hurdle than, you know, having a passport or something like that to be able to get into the traditional financial system.
Yeah. Colleen or Meltem, anything to add there?
You know, I think just from a risk standpoint, and I'm sure Meltem's going to have some thoughts on this too, but I think it's always useful to think about how things play out in traditional finance. And if this event had happened in DeFi, may it have been different? And I think an interesting one to look at is Archegos. So when Archegos blew up in March, I think a lot of the prime brokers were surprised to learn that Archegos had similar trades with several other banks because they had no visibility into what Archegos was doing. That was partly because Archegos was trading certain swaps that are exempt from the disclosure rules. So nobody could see, you know, what was going on. You know, Archegos had in excess of $60 billion of risk that was mostly hidden from their counterparties. So you think about that happening in DeFi, where those transactions are all on-chain and transparent. So while I think it is incumbent on the DeFi industry to help regulators and participants in the space understand where collateral resides within the system, it is discoverable, right? So you can see it because it's on-chain transparent. Additionally, if Archegos were in DeFi today, it's likely they would have had to over-collateralize those positions. They would have been automatically liquidated. The system is also working 24/7, 365 to protect itself, unlike traditional finance where you're 5 days a week within set time periods. Additionally, in traditional finance, often you're going to have negotiated for 24 hours to meet a margin call, just introducing additional risk into the system that's hidden. So I think these things are different. And then you also have the second order effects, right? So think about all of the employees at Credit Suisse, at least a $5.5 billion loss, who have nothing to do with the prime brokerage division, nothing to do with it, no transparency into what they're doing. And they're the ones that are going to have a hard time at bonus time. You know, they've done nothing, but they're not going to get the rewards that they deserve. Now, what's different today versus, you know, prior to the Bitcoin white paper and where we are now is those employees who are disillusioned by what they're seeing happen in traditional finance had no alternative to go to. Well, now they do. They can bring their efforts and their time and their attention to crypto and to DeFi. So I think from a risk standpoint, you know, as Rebecca said, we have to be honest and transparent about the new risks that DeFi presents, but we also have to look at the benefits. And I think it's really important because there's always two sides to that conversation. And often in these regulatory conversations and others, it's the benefits that get left out.
I'd just like to add a point around risk, margin, and credit in general. I think what Archegos also illustrated for an audience who may not be familiar with risk management and lending practices is how challenged the centralized clearing and margining space is. Today, only 25% of financial instruments are centrally cleared. And unless an instrument is centrally cleared, it's really difficult to net out and get margin against those positions. So I'll give a very simple example. Say, for example, I'm a hedge fund and I have $1 billion book. Let's say I have $1 billion in that long position, and I want to get more leverage on that trade. With margining, what I can do and netting, I can take that $1 billion long trade and offset against $1 billion short trade, which makes my net exposure zero effectively. And so, and I'm really grossly simplifying here. And so the issue is, unless you're dealing in centrally cleared securities, which means every day at the end of the day, they're reported to centralized clearinghouse like the OCC, the Options Clearing Corporation, which then calculates those positions, updates margin requirements, et cetera. And then there's a lot of like rules like Reg T in the US, which dictates how much margin you can get against your existing securities positions. It's really difficult for banks to keep track of how much leverage is out there. And with Archegos prime example, Credit Suisse didn't know the amount of risk that was present in Archegos book. And they were able to use the same amount of capital to obtain, I think, up to 8x leverage on that core base of capital. And we saw a similar thing with the firm long-term capital management. I don't know if anyone, has followed that saga, but it's like the same story just 2 decades ago, where again, we had a firm that I think had around 40 billion in AUM, but managed to amass $4 trillion in net exposure at one point, which is just absolutely mind-boggling. But again, the issue is because there's no transparency, because all of these relationships are relationship driven, right? Unless I'm a multi-billion-dollar fund manager who has a special relationship with Credit Suisse, I can forget about getting that type of leverage. What we end up having is this sort of system where we have very little ability to understand systemic risk. And even though, after 2009, the creation of SIFIs to some degree and the introduction of thin cap liquidity requirements and new rules around the amount of risk people were allowed to take, like we're supposed to reduce that. In fact, the system has only become riskier, and the risk has only become more difficult to understand as the number of venues and jurisdictions where people trade has skyrocketed. The different types of assets out there has also increased, and just the gross amount of capital in markets has skyrocketed as well. So what I think is really interesting about the crypto space, and this is where there's a fundamental misconception, there is not a lot of leverage in crypto. It is very difficult in crypto today to take out an uncollateralized loan. And crypto collateral is the best form of collateral in lending, and here is why. Today in crypto lending, if I have Bitcoin and I want to get cash for my Bitcoin and lever up, I have to deposit at least 110 to 130% in Bitcoin to get exposure. Right. And then the cash borrow rate's very high. Right now, it's around 8 to 12%. Over the summer, when DeFi was going nuts, early summer, I should say, is closer to 12 to 18%. So you have to deposit Bitcoin. And what you have to remember from the settlement side is Bitcoin settles with finality. When I transfer my Bitcoin to an institutional lender, they control the private key to my Bitcoin. There are escrow arrangements with multi-sig sort of key arrangements, but the person who is lending the capital has full control over that collateral at all times. And what you can now do, since this is all software and this is programmatically executed, you can actually programmatically set the parameters so that once your margin drops below a certain percentage, let's say it's 110%, that collateral is automatically liquidated. And what you can effectively do is prevent a systemic collapse or systemic credit event from taking place. So I'll give you a great example of a protocol called Liquidity. Full disclosure, I'm an investor in it. It's a protocol where you deposit Ether, and you have to have at least 110% collateralization ratio, but you deposit Ether and you can borrow a stable coin called LUSD, which is dollar pegged. The peg is maintained by this Ether collateral, and then you can go around and use your LUSD and all these different DeFi protocols. So the way the protocol works is once you drop below 110% collateralization ratio, you get liquidated, which is why it's called Liquidity. So what happened in May when Ethereum went from $2,400 to $1,800 overnight, over 500 million of Ether collateral was liquidated in a matter of minutes, systematically, without any third parties. This was just done as a function of how the protocol works, right? Anyone can read the code, anyone can read the documentation. It all happens systematically. And so again, what I think starts to become really interesting from a risk perspective is you start being able to apply much more fine tuning and much more control to the amount of systemic risk that's present. And these cascading liquidations that we see happening in other parts of the financial system, when things like Archegos get unwound, right? And Credit Suisse ends up holding like the $8 billion bag or however much they lost as a result of that, the propensity and likelihood of that happening in DeFi is much, much, much lower, again, because things are settling on chain with finality. You have full visibility into positions at all times, and you have the ability to actually programmatically facilitate liquidation waterfalls when certain thresholds are breached. So I think, again, there's sort of this idea that somehow there's this crazy leverage in the crypto space. People confuse levered products, right? Like I can can get 120x levered product. That's not the same as getting 120x leverage. There's no place in this industry where you're able to use your collateral to take out 120x leverage. It simply does not exist. So I really think we need to dispel that fundamental like misunderstanding. And we saw it come up in the Senate hearings. I was like, I'm sorry, this is like a fundamental misunderstanding. Like you completely misunderstand how crypto works. But even with the introduction of under collateralized lending, which I do think will come to DeFi, again, I think the ability to price, transfer, understand, track, and manage risk will be greatly increased because it's the best form of collateral there is, and it settles with absolute finality, which is something you do not have anywhere else in our financial system today, unless you hold a physical bar of gold or a pile of $100 bills. So I think that really can't be understated here.
Yeah. And in case anyone is looking for proof from that, you can do a little thought experiment. Crypto suffered like a 50% drawdown kind of randomly, between May and June. Ask yourself what would happen if the S&P dropped 50%. And nothing in crypto broke. So if you want some evidence about relative leverage, I would look in the existing financial system. And just to plug, there's a great book actually about long-term capital called When Genius Failed, which is a really cool, like very in-depth talk about what Meltem was just talking about, like hidden leverage sort of in the system. But I think something that we're getting to here, and a couple of ideas that I want to touch on, is this idea of transparency in DeFi. There is no Shangri-La. We're talking about a totally different paradigm, a totally different financial construction. This isn't going to solve every problem, but I think one really important idea is transparency and having an open financial system where it's not just relationship based and anyone can interact, and there's just more transparency into the types of relationships that exist. So I don't know if anyone wants to take this, like, what are some of those real fundamental implications of having an open financial system that anyone can interact with versus the closed system that we have right now? Don't everybody go at once.
I mean, I'll talk. I think the transparency is novel, but I think it also allows you, I mean, I'll say what I think from a market perspective, but I'm sure Meltem and Colleen also have other perspectives as well, but it allows you to do what Meltem is talking about, which is track what's going on in the financial system in a way that, one, can help you make decisions, and two, can also help you protect yourself and your transactions in a way that you can't necessarily do now in the traditional financial system without there being an intermediary who you have to, use and communicate with in that way. And when you said, nothing broke when we saw the big drop in May and June, nothing did break. All of the market participants came in a way that makes sense, whether you have liquidation bots or actual physical liquidators who are behind the scenes looking at things to ensure that the system can continue on in the way that's intended to, and that you have enough people who are committed to the system, I think also stems from the fact that the system is so transparent. So I think that's really important. And I will just say, I obviously have to do a lot of legal and compliance calls with financial institutions and things like that who are looking to get into DeFi or learn about DeFi. And one of the things I talk about a lot is the transparency. And even when I talk to regulators and stuff like that, the transparency makes a huge difference from a compliance perspective, not necessarily on the counterparty risk, but just ensuring that you know how the system is working. And to go back to sort of the hacks we were talking about and things like that, risks that may occur, the transparency helps from a law enforcement perspective in a way that is never talked about publicly. And I was in private practice up until about 5 months ago when I joined Aave, and I did a lot of regulatory enforcement work. And I represented a lot of clients who even got like third-party subpoenas and stuff like that from the DOJ or the FBI to help track down hackers and things like that, where the hacker may have put funds through the protocols or things like that. And we were able to say, look, here's all the public data. Here's how you track it down. Here's how you can track the person. And I think that hacks and other types of things like that are solved much more quickly in crypto than they ever would be in the traditional financial system because of the transparency.
Yeah. And there's actually a great example. I feel bad because I bring this one up on BNY. I swear I'm not picking on you. This is just the one I have off the top of my head. But there was an example of BNY Mellon where, people didn't want to pay upfront fees for foreign exchange transactions. BNY says, no problem, we're waiving fees. But ultimately what they ended up doing was they just routed those orders to their own trading desk. And there was they had some flexibility on when those orders actually got executed. So they ended up just executed the trade at a time of day where they could capture a larger spread. So in effect, they could say, hey, we're not actually charging you here, but in effect, you were paying a much more expensive hidden fee. And also, it doesn't even necessarily need to be, hey, there's all this leverage in the system and it could all go bust. Just this idea of not having any access, right, into how this stuff works. And that's just so different if you look at a protocol like Aave. I do want to talk a little bit just about kind of the future, and maybe Colleen dive a little bit into what you were describing at the opening here, which is just how do we continue to onboard more and more users into this ecosystem? So, you know, let's say I'm someone who doesn't have the conviction that I do about DeFi, and I'm looking, I say, hey, this looks kind of like the Wild West and there are hacks and I don't really get these games and stuff like this. Like, what would you say to me, right, about why I should start taking this space more seriously?
Yeah, I mean, you know, we've thought for a while that, and I hate to keep going back to games, but I think this is where it does start to get exciting as you have these different applications built on top of this foundation of DeFi. But, and kind of also picking up on where Rebecca left off, you know, if you think about a game like Aave as a gamer, it's almost like once you have that transparency into the game, where I can track daily active users, I can track what's happening with the marketplace economics, I can track what percentage is going to users, I can track who around the world is participating in that system from what geographies. It's hard to go back. So I'm a Pokemon Go player, right? And I need to wean myself off of that because I am not getting paid for my time in Pokemon Go. I need to switch over to Aave where I'm going to get paid for my time and attention. I mean, you know, Meltem was talking a little bit about some of the activity in DeFi, you know, liquidity mining and things like that. These systems are all very similar, right? So like in Bitcoin, you're providing hash power and you're getting rewarded. In DeFi, you're providing a monetary asset and getting rewarded. In gaming, I'm providing my time and I'm getting rewarded. In all these cases, you're taking what could be otherwise unproductive assets and making them productive. And so what we have to do to onboard the users into this ecosystem, because they have to get there in order to understand like what it can really be for users to be owners. I think education, we have to just keep doing more and more there, better UIs and UXs, better scalability. And then like in the gaming space, you know, games that people love, and it sounds really corny, but I think love is an important element. So I think about games like Aave and Skyweaver, and those teams are building those games with love. Like Matt Ball, who is, used to be with Amazon Studios, likes to say that the most important element in entertainment is love. And if you build these narratives and stories with love, you're going to end up with outsized profits. Think about Star Wars, Marvel, right? And so I think that, again, what differs there is that those profits that you can generate from infusing love, not only to brands and IP, but the technology itself, it's going to be shared with everybody. So again, it's just this different paradigm, but we've got to take care of these basic things to get people into the ecosystem. I think it's just education, better UIs, UXs, better scalability, better interoperability. So those are just some thoughts. I'm sure Meltem and Rebecca have a bunch more.
I think the only thing I'd add, and maybe I'll be a bit contrarian here, I think DeFi is still in its very early stages. And, you know, I think there's less than probably 1 million wallet addresses that are interacting with DeFi, even on DeFi protocols, even on a monthly basis. And I'll go ahead and say something else controversial. What I love about the crypto space is that in crypto, individuals can be more powerful than institutions. And in crypto, we have individuals and firms run by groups of individuals who have more capital between them than some of the largest financial institutions. And I think this trend will only accelerate. That's why I love being in crypto. Like, where else could I, as a 34-year-old woman, do the things I'm doing? Most banks won't even return my calls in the normal world. And in crypto land, like who I am, my identity, none of that matters. The only thing that really matters is, you know, the fact that I have a wallet address and that I'm willing to engage with these protocols. Today, that audience is still really, really, really small. I don't know that DeFi will ever necessarily become incredibly mainstream in the sense that people will directly be interacting with DeFi protocols. I think the way it happens is through companies like Outlet, which we're an investor in, pardon. Outlet is a savings app. The majority of their clients don't know anything about crypto, but they're offering a checking account and a savings account with a very high 9% annual yield. And so when people are looking at getting 10 basis points at JP Morgan Chase or getting 900 basis points at Outlet, right, they're more than happy to deposit some of their funds into Outlet. And on the back end, you know, some of these platforms are earning that yield through participating in different DeFi protocols and liquidity mining opportunities. And so I apologize, there's construction going on upstairs. But I think, again, that's a really powerful example of how a lot of the complexity of DeFi will get abstracted out.
Yeah, absolutely. And no worries about that sound, Meltem. We've all been held hostage by contractors before. Do what you got to do. I guess like we've got 10 more minutes here before we turn it over to audience questions. And Meltem, you just brought up this idea of institutional involvement kind of in this space. And there is this question of like, what does an institution in crypto look like? But Rebecca, I'd be curious to kind of pick your brain on this, just because Aave, you know, you guys still do a lot of things now, but when I think about Aave, I think of the core product, right? This like open kind of borrow and lend protocol that anyone can get access to. You're kind of making forays into the more institutional sort of world. So maybe you can talk about how you think about more traditional financial institutions acting with protocols like Aave.
Yeah. So people have asked sort of how, you know, what was your thought process in bringing DeFi to institutions? And for me, it came to us. We had so many requests from financial institutions. How can we get into DeFi? We have all these regulations that we comply with, all of these things. So it was really, again, like everything, it came from the community, it came from, you know, potential users, all of that kind of thing. The way Aave Arc is going to work is it is the traditional deployment of the Aave protocol, but it will have another smart contract layer on top that allows for the whitelisting of wallets so that there is who all go through KYC, or the owners and users of those wallets all will go through KYC. And then you'll know at least the level of KYC that has gone on in the pool. Do I think that financial institutions could theoretically interact in DeFi protocols today without the KYC? Possible, but I just don't think that the way they view their various regulatory regimes will allow them to do it. So this is a way that will allow them to get in. The protocol is going to work the same way. It's going to be controlled by governance, and all of those good things that come along with the the traditional deployment of the Aave protocol as well. But I think that there's such an interest for this. And a lot of the legal and compliance calls that I'm on are with legal and compliance from these institutions who are interested in getting into the Aave protocol, that this is sort of the next or another wave of DeFi.
Yeah. And also to just like play devil's advocate and ask this question, like I think one of the best things about DeFi in general and why it's so exciting is this open financial system that anyone can plug into. Is difficult to censor people. You know, the kind of criticism that gets brought up a lot of the time as well, then you could have illicit actors using it, and institutions have these regulations where they need to do KYC and all that kind of stuff. I mean, how do you see sort of the fundamental ethos of DeFi being like, anyone can plug in, it's non-censorable, we don't monitor that kind of stuff with something like Aave Arc?
I think both can exist, and I think over time, as either regulation changes or understanding of crypto changes and things like that, they may meld. But to Meltem's point, and I agree with this very strongly, we're in like an R&D phase for DeFi, right? Everyone says like, oh, you're supposed to be banking the unbanked, and why hasn't it taken over the world? It's like, it's 2 years old, 2.5 years old. Like fine, Maker was 2017, 2018, but this is a very nascent system and super sophisticated, which is why I think that, and there's obviously been a lot of interest in capital and things like that. But it still is we're still early in the system. People are still innovating to the point you talked about earlier with the risk mitigation solutions. People are still innovating those native types of solutions like we're building. And we should be allowed to continue to build and experiment in a technologically responsible way.
I just want to add to that as well. I think one important thing to keep in mind, this is, a very US centric and regulated finance centric panel, but let's not forget, like, the world is a very large place, and fundamentally physical jurisdiction has dictated what financial regulations you fall under. That world of regulating based on physical jurisdiction is fundamentally incompatible with what's happening in the crypto space and what's happening on the internet more broadly. We saw this with the advent of the internet, with streaming, with file sharing, with BitTorrent, with all of these protocols that fundamentally challenge the ability of nation states and nation state regulators to control the flow of information, and IP rights and other sorts of rules on the basis of physical borders. Like, this is a new paradigm, and I do think we're going to see a lot of regulatory arbitrage. I don't live in New York anymore. You know why? Because the bit license is an absolutely terrible piece of regulation. I may not live in the US in the next 5 years if the US doesn't get its act together on the regulatory front. A ton of firms have re-domiciled to other jurisdictions. A ton of firms have set up offices in other jurisdictions where regulators are more permissive. And at the end of the day, right, I have the ability as a sovereign individual to pick up and go anywhere in the world with my ledger. And at the end of the day, if jurisdictions aren't going to be friendly to the trillions of dollars of capital that are going to be running around in this space, then these companies, this industry is not going to exist in those jurisdictions. And I think that's what like people are not understanding. This sort of concept of regulating based on the basis of physical borders, like, that world doesn't exist anymore. And if anything, I think over the last 18 months, the authority of our institutions has been massively eroded because they haven't even been able to respond to this crisis, financial crisis, political crisis, economic crisis, social crisis, with any modicum of coordination or success. So I find it laughable, this idea that somehow there's like a new cop on the beat, not, to quote someone specific, but I find the idea that, the regulators are going to come in and, suddenly regulate with an iron fist this fully digital 24/7, 365, like peer-to-peer software driven ecosystem. Like, how, where, who, like, it's just completely laughable to me, which is not to say that the regulatory side isn't incredibly important. We're a regulated firm in 7 jurisdictions. We take our compliance obligations very seriously, but you can't arrest an idea. And I think it's hilarious to watch regulators try to ban ideas, try to ban encryption, try to ban peer-to-peer software. Like, it's simply not how the world functions. And the velocity and the pace of this industry is just far too high to be entrapped by regulatory capture. I think that's the interesting reality. So I'm curious to see how that tension continues to unfold. But again, we as individuals are more powerful than institutions. 300 million people around the world own or participate in Bitcoin in some way, shape, or form. That's already one of the largest nation states on earth. 15% of Americans own cryptocurrency in some form. This is not some like dark esoteric corner of finance. This is mainstream. It's here. And these people want to participate in what's happening in the ecosystem. And if they can't do that here, they'll go somewhere where they can. And that's my view. And I think Colleen articulated it perfectly. Like, it goes back to love, and people want to do what they love. And if you're not going to let me do that, then I don't need to be here. And I think that's frankly just the very simple reality of how the regulatory front is going to shake out. And I get very fired up about it because people have like this idea that somehow crypto is going to end. I'm like, where? How? Please show me a single regulator who has the ability to do that, because I haven't seen it yet.
I mean, also, it's just like, again, it seems to be, it's not in the US's business model. The business model of the US, so to speak, is we encourage innovation here, and then we make sure we take our piece of it, as opposed to like I mean, it is interesting to watch what's going on in China right now, like some of the crackdowns that are going on the regulatory front. They have a totally different view to this kind of stuff in general. So I totally feel you, Meltem. I think it would be a huge missed opportunity if we really tried to crack down. And I understand it erodes some of our advantages around like control of the financial system and stuff, but I think it's super pro-US to encourage that sort of innovation here. I want to end with one like hopeful sort of thought from each of you. I was telling Colleen, I steal this analogy like all the time. Avichal Gard came on one of these webinars a little while ago. He gave this great analogy about the iPhone, which is that everyone thought on the iPhone, the killer app was going to be the map. Because it helps you navigate everywhere. But actually it was the inverse of that, because the iPhone allowed the world to come to you. And it's this idea of it's very hard to predict behavior in emergent technologies. So just expanding on this idea that we're so early in DeFi, we're in the R&D phase, like the exciting stuff might not even have happened yet. What is one thing that each of you is just really excited about, like gets you out of bed in the morning, you're like, I'm excited to work in this industry because this is happening?
I mean, I'll start. Because I don't sleep that much. So I get out of bed very early in the morning, but it's partially because it's what Meltem said, which really like hit me in this amazing way. She said, you can't arrest an idea, which I've never heard anyone say before, but like, I do think this is transformative. And her point that like people who want access to this will go and find ways to get access to this. This is a truly transformative way to think about the world. And honestly, it's going to affect obviously people's financial independence, but we're disintermediating everything, right? Like there's this concept of disintermediating social media and giving it back to people. And so bringing finance, culture, and social interaction back to the people who really are supposed to own it, the users, right? The participants, is a really exciting and inspiring concept for me on a day-to-day basis. So.
Yeah, I'll just pick up on what Rebecca said. I mean, I think really we should have just stopped after Meltem, because that was such a great way, to kind of frame where we are. But picking up on Rebecca and Meltem, to me, it's an opportunity to try to fix a lot of the things that I think are wrong in our existing system. Chief among them, this idea that only wealthy people, accredited investors, are suitable to participate in certain opportunities in our system. And this is really a way to change that dynamic and allow people to generate wealth. And wealth is very different from income. And that's the opportunity we have in this space to kind of flip the model on its head, where this is a system that's been built by the bottom up. I call it the people's financial system. And I think the people have the right to own it, and to turn it into anything else is just not acceptable. And to Meltem's point, you can't, there is an inevitability associated with what we're building here. I can't predict how this is going to go, the ups and downs, but I am certain as to where we're going to get to. So that's what excites me. Like Rebecca, probably Meltem too. I don't really sleep that much. I absolutely love what we're building here. And that really is the key for me. It's a system for everyone.
I love my sleep, so I'm pro sleep.
I was going to say, I need sleep. Good for both of you. I sleep. I have to do it.
I just feel woefully inadequate at all times. It's great.
Okay, well, we've got about 12 more minutes here, and I do want to get to some audience questions because we have a bunch. Meltem, I'll call this one out because I see you wanted to answer this one's. Basically just talking about under collateralized lending in DeFi, and just to give some context there, I've personally heard that's the next frontier that folks are working on. We had someone in the audience say under collateralized lending will only work if you can describe cash flows and algorithmic standards, which are fully coded into smart contracts. So Meltem, what's your thought on just under collateralized lending in DeFi? Is that something we want? Is that something is achievable?
Yeah, and I think the reason I liked that question is really the context in which it was pointed out is, one of the things that's really interesting and really I didn't appreciate until I started working in Bitcoin in 2015 is like the world runs on leverage. Leverage is the lifeblood of markets. Leverage is the lifeblood of economic growth. And you can see where leverage has gotten us, right? Like the S&P is at all-time highs, but the global economy in real terms is like just crumbling. So we have all of this leverage in the system. And what's interesting is, the growth of the U.S. for large part has been driven by fractional reserve banking and the move off the gold standard. And so I think one of the interesting concepts that Bitcoin reintroduced was this idea of full reserve banking, right? You can never borrow more than the value of the Bitcoin you have in this sort of fully collateralized system. I think the question as to whether or not growth is possible is a question as to whether or not you believe that what we have today really is growth, right? The price of everything is inflated because the cost to borrow is effectively zero. The 10-year is at 130 basis points right now. Real inflation is at 6%. Your only option is to borrow and to just gamble. Like to gamble like an absolute degenerate with the hopes of making more than 6% a year just to keep pace with inflation. It's absolutely wild, but it's also not unexpected. This is what happens when you have an economy, like a global economy, that's predicated on this idea of insane amounts of debt in the system. So I don't think the question is, can DeFi grow or not? I think DeFi will continue to grow, and we'll see people experiment with under collateralized and uncollateralized lending, accepting different types of collateral, particularly more liquid types of collateral. We're already seeing some of that experimentation today. I think the question really is like and again, I'm going to sound like a crazy person, but I think there is this really interesting perspective that when this debt cycle ends, and we've been in like a 40-year debt super cycle, when this debt cycle ends, right? What is the next thing that emerges? And I myself am very partial to Bitcoin and this idea of fully collateralized lending, fully collateralized full reserve banking. Because I think it introduces a level of monetary discipline that we haven't had. So I think the question is, what type of growth are we aiming to achieve? Are we aiming to achieve like growth in numbers? Well, the reality is like the S&P has grown like 60% in the last year. The value of your portfolio is not going up though. It's the value of your dollar is going down. So I think the question is, what's the objective measuring stick you're using? If we're benchmarking against dollars, yeah, we can make number go up infinitely by just printing an absolute fuck ton of dollars, and we can do that in perpetuity. But if we're talking about actual purchasing power parity and economic value, I think that's a fundamentally different question. So that's why I thought the question was interesting. I do think growth is possible, and I think at some point, even improve some of the proof of stake protocols or some of the DeFi protocols out there, the yield you're earning is not actual yield, it's pro rata inflation in the protocol because more tokens are being minted. So I think there are like fundamental questions around, what does growth actually mean and what's the right measuring stick for growth? That's not an answer. That was more questions. I apologize.
That's really interesting, Meltem. Actually, it kind of leads into this other question. Then I want to open it up, but I want to get your opinion because you just brought it up. I know, Meltem, you've probably answered this question a million times, but one just consistent question that I always get is, we were talking about high yields. How are these high yields possible, right? And just to like add a little bit of nuance to that, maybe if you could talk about like where in crypto those yields are being generated, because there was certainly a period of time where kind of like the basis trade and the grayscale arbitrage, like those were big yield generators. From what I've understand, the source of that yield has actually shifted. So maybe you could just kind of, wherever you want to start with that whole thing.
Yeah, I can get it started and then I'll pass to Colleen because I know CMT is also really active in the trading space as well. So look, for a long time, the primary sort of yield in the crypto space came from cash lending. So if I have cash, right, I can buy CDs or 10-year treasuries, or I can lend it out for crypto collateral, which, as I've already mentioned, is a really secure, really robust form of collateral, very liquid in many instances, at 8 to 10% per year. So I think historically it's been primarily crypto collateral that people have taken, and they're lending out cash for crypto collateral. Typically they'll go through an intermediary who's experienced at liquidations and managing that and is matching counterparties. Now with the introduction of Aave, right, I can go right to Aave and I can deposit in a pool, and Aave performs that function for institutions who want to do that in size. Paradigm.io is a great platform for that. They just rolled out multi-dealer RFQ for lend and borrow. I'm an investor. We're super excited about that product. There's also DeFi generated yields. So in the DeFi market, there's a lot of different types of yields. There's lending and borrowing yields that are typically stablecoin driven. There's also yields where you can yield farm, where you're earning new tokens. So that's like earning inflation in these new protocols that are also growing in network value. And then there's a variety of new models that are being introduced. But Colleen, maybe you could share more around how you guys do this at CMT, since our firms are similar, since we have trading DNA and degenerate trader DNA. Like, I want to scalp all the yields all day.
No, that is definitely true. Yeah, just picking up on some of what Meltem said, it's definitely the case that in the early days, a lot of what we were seeing was driven by the grayscale trade, the basis trade. And, now we've got other different types of trades that are driving the yield activity. One thing we think about a lot, though, and it kind of goes back to Rebecca's point early on about the elimination of intermediaries, is and Meltem, I'll be curious to see what you think here, but I mean, I can't really think of another time where you've got retail people supplying assets to trading firms. Typically you'd have to go to a traditional prime brokerage in order to have that kind of a relationship. And now, anyone in the world with an internet connection can be supplying to a protocol like Aave. We can be in there as a proprietary trading firm and borrowing directly from retail people. It's just a very different dynamic in terms of what's available. And then, I think you also have to keep in mind that there's still, a significant number of crypto exchanges that don't have fiat on and off ramps, which is also going to cause a lot of need, to borrow stable coins, right, for trading purposes. So there's that, to Malcolm's point, much of the world is not the United States. And so, that is a key factor too, in what's driving some of the activity.
Colleen, could I actually ask you to be, just because I'm honestly curious about this as well, like in terms of specific trades, without revealing any proprietary secrets for CMT, can you just give the audience like an idea of what you're talking about with some of those trades?
Yeah, I mean, you've got your basic arbitrage trading activity. You've got the basis trade, because you're always kind of looking at the different, and again, it gets into geography, like differences where, and different frictions, right? So you think about a platform like Deribit, where you've got options trading, and there's some jurisdictional differences there versus CME is obviously futures. But you've got spreads across all these different platforms trading similar products, but there's different frictions associated with them. And there's a lot of trading activity just around that. And then, you've got these new DeFi programs really starting up every single day and trying to be on the cutting edge of that and moving assets around to take advantage of opportunities there. I mean, it's really pretty diverse. And what's been interesting for us, I mean, it started out really simple with just ARB opportunities, right? In the early days, just spot ARB, where you see these big differences with the same asset across these different exchanges. And then you realize like, well, okay, it's hard to get one out of Korea. That's why I'm seeing different pricing in Korea versus the United States. And then for us, where it started to get really interesting, because CMT historically is a derivatives trading shop, the two founders are options traders by background, is now we've got sufficient liquidity first in centralized derivatives platforms, and now in decentralized derivatives platforms, not quite to the level we need yet there. But that's where you can deploy real trading strategies that we're used to deploying. But again, you've got these jurisdictional frictions that aren't entirely analogous to what you see happening in traditional finance. And then I guess to take it one more layer down, we also have things like MEV, right? Minor extractable value. Yeah. And there's opportunities around things like that. Now, if you want to go deeper, you could say certain aspects of MEV are actually similar to payment for order flow, which is an interesting discussion in and of itself that we talk a lot about internally. But there's these new opportunities also that we're developing strategies around. And that's also causing more. I know it's not a completely clear answer. There's just a lot that's going on in the space.
Yeah. We could do a whole another hour on MEV in general. That would probably be really interesting. But we're running down to the close here, and unfortunately, we've got to wrap things up in about a minute. So I just want to say thank you all. I wish we could have gone longer and answered more questions. This has been a really interesting conversation for me. So Colleen, Meltem, Rebecca, thank you so much. And again, an extra special thanks to Aave for making this conversation possible. We're talking about kind of emergent things that were not possible before. I would call Aave actually a prime example of that. So I'm sure folks, you've probably heard about it before this webinar, but if you haven't, or if you haven't gotten a loan or tried to interact with that platform, I highly recommend that you do. So thanks so much, everyone. This has been a really, really enlightening session for me, and we'll have to do it all again soon.
Thanks so much.
Thank you.
Thanks, team.
Thanks.
Bye.
Bye, everyone.